So you know what is NPA, right? When the loan is become NPA, it is always risky for the bank because the borrower is not probably there are so many factors we have gone through why the loan become bad. So many factors, right? So it's behavioral factor, right? And there is a financial difficulty side of it, where he is unable to manage his own finance. There could be external factor, geography or industrial factors could contribute. So remember, you need not to divide in exam point of view. You need not to divide. Say, what are the just list down three warning signal of a bad loan, or what are the warning signal you could see when the lending is given to a particular borrower. You there are certain warning signals. So what are those? You need not to categorize as geography, industry. You can simply write there could be a financial. Mostly the financial indicators are important. External factor cannot be avoided, right? So you can't avoid the external factor. Only you could avoid when the financial behavior of the customer changes. You have to smell it, and there is something going wrong here because he's not responding to your call. He's not giving what the information you require. He's evading and he's not giving information. So these are the factors that could be alert the bankers to take precautions, right? So when an NPL is there in the books of the bank, it is always is a bigger issue for the bank. It's more riskier because what happened when NPA means the loan is non-performing. So the person who borrows the funds is not paying the interest. Sometimes it comes to a particular level. I think we have gone into four categories. It is a loss position. Anything more than 1.5 year, 540 days, the central bank says, okay, it has to go to the loss, and you have to 100% you have to absorb it. So just imagine if the bank gives a loan and if the borrower doesn't pay interest over a period of time, these loans need to be categorized according to the law of the country. So we saw the provision there had been a law. So according to that, these loans need to be categorized into four categories: overdue, substandard, right, and the loss situation, bad and doubtful, loss. The last is a loss. So if it is a loss, then you need to absorb. So when there is an NPL come, definitely it impacts the profitability of the bank. So you are unable to collect your interest. So it's a reduction in the net interest income. So the major income of the bank is coming from interest income. So if that is what affect, that means that definitely that will have an effect on their profitability. And impairment means they have to provide provisions. Yeah, they have to set aside an amount that is called impairment. So that, in other words, you have to do impairment. That is, you have to keep a certain amount as a provision to absorb those future unforeseen, unpredicted losses could happen. In the event if the losses happen, then there is no way that you could take it from the current year profit. So you have to keep an amount set aside, right? That is called impairment. Additional capital requirement, yes, you need to increase your capital. What happens when you have high risk weighted, the capital adequacy is the something where the central banks regulators always tell the banks you have to increase your capital. Why banks capital need to be maintained a certain level or beyond that? Because what happens when bank take risk and when the bank grants loan, if the loan become NPA, after certain period of time, these NPA loans become lost, then bank has to absorb it. The loss need to be absorbed. That loss cannot be passed on to the depositors. So as a result, what happens? Those loss need to be absorbed by the capital of the banks. Therefore, if you increase your capital, if the shareholders' funds are increased, that has a cushion to any losses future happen that could be covered. Therefore, the bank has to provide more capital to cover the high risk weighted assets. The high risk means each and every assets has certain amount of risk carry, right? When I say assets here, all that are loans and advances. Always remember, high risk weighted asset means each loan has its own risk, right? So when we do the ratios, I will explain to you. Lower ratings, and definitely if your non-performance loan increases, as a result your profitability come down, that will going to affect your ratings of the bank. Their ratings, each bank has a Fitch rating, like country has a Fitch, our country has a rating. Each organization, each financial organization, and most of the public quoted company has a rating. Even that rating get affected, right? Then if you don't have funds, reduce appetite for new lending. You don't have money because you are already having a carrying NPA. So you need to absorb the losses. So you will be very careful in your lending. Therefore, there will be opportunity comes, but you are not interested because you don't have funds to lend. Because most of the loans are in a bad shape, right? Additional management time and saving cost. Yeah, you need to have a separate department to manage this administration. Credit administration department will be set to look after these. Right. The most important role to protect this asset. So, what are the things bank could look at it? How best they can manage this? So, how key preventive measures mean? How best you could avoid it? Definitely remember NPA is something is inevitable. Any industry NPA is inevitable, but you can still try to make maximum precaution to reduce it. You can't stop it. It could happen at any way. So you need to be managed efficiently from day one. Then the probability of NPA coming in or as increasing can be stopped at a certain level. That is what you call mitigating factor. So the very important point, remember, you should know your client. When you are lending, you should know the client in and out of the client. Simple terms, you should have a better dialogue with the borrower before you lend. What type of person? I think we learn 5 C's: character, capacity. Very important whether he has the capacity to repay the loan. That is vital. Any loan that you are giving, remember, no assets is no, all these securities are not material. Is repayment capacity. That is what I saw when somebody unknown people or the general public might approach you when you say you're working in a bank. They say, I have a house, can I borrow from a bank? So remember, the answer to that is no, not your house. That is only taken as a security. Whether you have a repayment capacity, whether are you earning, are you a salaried person, or are you a business person? If you're a business person, how do you ascertain the business person income? Going through the bank account. His profits are, his incomes are deposited into a bank account, business person. Then he has to show the bank account. If you are a person working in an organization, you are a salaried person. Your salary slip is the only source of income, right? And part time you may do any other job. Then show some document evidence to prove that you have a income earned so much. So this is how you prove your income, right? So bank should better understand the client, how the particular person going to repay the loan. That is very important. That is the basic principle of lending. So we saw 5 C's, right? The proper credit risk management. So you need to evaluate each and every proposal on its own merit and make a decision whether this particular loan can be granted. Of course, you need to maintain a communication with the client very frequently. So where most of the NPA become bad because of the lack of communication. From day one, you start a dialogue, because what happens when you give the loan, some banks think when they give the loan is dispersed, the loan is granted, and if the target is achieved by the branch manager, it's fine. No, the problem comes then they are in after. The problem comes, so you don't follow up with the customer. Then you have other headache, your NPAs are increasing. And the head office comes and do the audit, and the head office credit administration unit from head office asking your branch portfolio. When you give, you have most of your 50 to 60% loans are NPA. So your branch is going to be categorized as a non-performing branch. Your profitability, definitely whatever order and profit that you make, everything going to be taken by these bad loans. So you have to ensure you have a communication with the customer, understand the customer's requirement according to tailor-made solution can be given to the customer based on his credential. 5 C's method, we learned that. Then with the status of early warning indicators. Yeah. So remember, if you get some early warning signal, which we have discussed, right? What are the previous class? So the moment you know something, the customer not answering the call, the customer asking frequent overdraft facility, the customer asking working capital loan frequently, or its limit is fully utilized. These are some of the indications, right? And he's evading giving the stock statement. He's evading giving the audited accounts. These are some of the indicators. So when this is happening, that is a warning. So you have to immediately call for a meeting of the customer, or you may personally visit to the business and see why wrong, why it's not evading, why it's not giving all this information. Address it immediately. Take action taken side. Yeah, you need to have your internal bank has internal policy, as well as the regulators. They have their regulators have given certain guidelines. Accordingly, the loan need to be administered as per the terms and regulations. Early warning reporting, yes, that is where the very important. Some of the banks are, unfortunately, they tend to not to know what the impact of warning signal. Sometimes you get a query from one of the customers from inland revenue, so that should give the indication. Oh my God, why inland revenue? That means he is evading tax payment. That is what the query coming. So it should be put alert to you. Why is he financially unstable? Why is not making the tax payment, or is he evading? Then the next probability that he might not going to repay your loan as well, right? So that is the indication example, right? So so you can make some small notes for your clarity purposes before we go to the provisions, right? So uh, you can say NPA NPA need to be efficiently managed. Need to be NPA mean non-performing advances. Huh? NPA need to be efficiently managed. Need to be efficiently managed since 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 banks major income since banks major income since banks major income is earned from since the bank's major income is earned from interest earned from interest. Next para you can say when NPA occurs, when NPA happens, or when NPA occurs, when NPA occurs, it is not just when NPA occurs, when NPA occurs, it is not it is not just an interest. It is not just an interest. It is not just an interest. Interest. It is not just an interest income. It is not. It is not just an interest income loss. It is not just an interest income loss to the bank when NPA happens or occurs. It is not just an interest income loss to the bank, but a but but a capital or the principal loan amount, capital stroke principal loan amount loss as well. The principal loan amount loss, LOSS, loss as well. So it is not just a interest income loss, but it is the principal amount or the loan amount loss as well, right? So you need to understand it is not the interest. The interest is something that you are incurring losses that you can manage at least. Your capital loss means you need to absorb the losses, right? So that is where the danger is. It's starting from affecting your income, and it's going to affect your capital as well. So you should write when you are exam point of view. Remember, when you are writing NPA, target both. It is going to affect your income statement as well as your loss. Absorbing losses means that going to affect your balance sheet as well, because capital, as all the banks shareholders funds are in the balance sheet, that is also going to impact, because if the losses happen you need to write off from your shareholders capital, so it's going to affect the balance sheet also. So it's affect both ways, remember. So in order to, then you can next para you can say in order to maintain in order to maintain in order to maintain set of performing loans in order to maintain set of performing loans in order to maintain set of performing loans set of performing loans instead of NPA, instead of NPA, instead of NPA, the bank should the bank should administrate the bank should administrate the bank should administrate the asset portfolio carefully. Bank should administrate the asset portfolio carefully. Bank should administrate the asset portfolio very carefully or carefully. Example, you can say how they are effectively administrating. Example, you can say proper credit evaluation. Example, you can say proper credit evaluation. Example, you can say proper credit evaluation. Proper credit evaluation, stroke credit administration. Proper credit evaluation, stroke credit administration. Then continuous communication with the borrowers, continuous communication with the borrowers, and compliant to the internal and compliant to the continuous communication with the borrowers and compliance to the and compliant COMPLIANT, compliant to the internal policies and regulations and regulations, internal policies and regulations. So that is where you need to be aware of NPA, right? Moving on to provisions. What is provisions? So when loans are NPA, when loans become NPA, then according to central bank, there are certain amount of provision you need to provide. So generally banks provide the provision for all the loans, right? But central bank says if the loan is into substandard category, you need to provide 25% of the amount due from the credit card facility, other facility 20%. If it is a doubtful, 50% of the loan facility need to be provided as a provision. Say you have a 1 million loan. If the 1 million loan is gone into doubtful category, so that financial year you need to take 50%. That is out of 1,500,000, you need to provide provision. That means you have to take it from your income and set aside as a provision. If that particular loan got into loss category, that particular financial year, you have to write off the entire, that 1 million, the example of 1 million, you need to take the entire 1 million out of the loan books has to be closed and the entire 1 million has to be absorbed by the bank. So you can see the risk. If the bank loans become loss category, 100% need to be provided. The provision means you keep from your current income, you keep a certain amount to look after these losses. That is called provision. So provision, when you are doing provisions, mean whenever you have an income. So suppose say, as an example, if your current personal life, if you want to do something, or if you have a future expenses unpredictable, you feel that you want, there could be some obligation, financial obligation you need to do next year, right? Next year you are planning to do some financial, but you don't know the amount. But what you do current year, every month you keep an amount set aside. Okay, I keep 5,000 because next year I have a commitment. So every month you keep aside 5,000, 5,000. So by end of this year you have a 60,000 already. But next year financial commitment end up with unexpectedly 150,000. Then you have already this 5,000 into 60,000. You need to balance 90,000 only. You have to look for next year. So that 150,000 is something where the bank is unable to recover from the borrowers. That is the NPA loan. So you never know how many loans will become go into NPA, because the moment you know the certain loans categorized into NPA, you start providing provision, because you never know it goes into the next basket. Substandard, then bad and doubtful, then loss. So you know it's every 6 months or 1 year period, the loans are shifting from one bad books to other bad books. So by tenor of this 1.5 year, everything need to be done. So you have to be bank has to be very prudent They can't. The central bank also given instruction, you must provide provision. So bank cannot cannot violate these regulations. So bank very well aware, if they don't provide provision, if the bank supervision department of central bank comes and check the books on a regular basis, then you will be fined fault. Then they will impose a very big penalty to the bank, not compliant to the regulation, violating their directions, right? So your bank has to be very careful. So you see the losses, right? So bad provision means you are keeping a amount as set aside from your current year profit. That is why you are keeping aside. In next year, this bad loan become loss situation during the span of that particular next calendar financial year, anytime. Then you don't have any money to absorb. You have provisions to support. That is the reason every year you need to do the provision, right? Impairment is when the loss of the whatever the assets value decline immediately. So so sometime what happened, it is the asset value. You can see this picture what I gave, loss due to the impairment. That means $50 worth of item can be the market due to the crash of the market, it's 50 cents. So the recoverable amount of the assets decline due to some unexpected event. Then what happened? The book value cannot carry anymore in $50 because the book value, though the book value is $50, the current value of the book, the particular asset is 50 cents. So it is called impairment. That means you have to absorb immediately from your P&L, profit and loss account, because though you are keeping the asset as a $50, it's a real asset, not even $1, 50 cents. Then what happened? Because of the crash of the market, the property value has gone down. So something similar when you are giving a loan due to some recession, due to some current pandemic, most of the loan get into this category because they don't have any money, because their assets, the bank's loans are in the form of assets. Those assets value can drop in the event of some drastic decline in the economy. Then what happened? Then you need to set aside a particular amount. So this is, in other words, impairment is generally considered as when the recoverable value of an asset drops than the book value, then you need to equal to the current recoverable value. For example, let's say you bought a property for 5 million. The property prices crashes. The property value is now only 3 million. So in your books, you are mentioned as the actual acquired value as 5 million. But the current price is only 3 million. So you need to adjust your book. So you need to make your book as a 3 million, then the 2 million losses you have to absorb from your P&L. But the impairment will not work the other way. So let's say your asset is 5 million. The current, due to some unexpected events took place, the property market has gone up. Now remember, in accounting, though you acquire the 5 million assets as the book value, it's still in the book value 5 million. The current value of the property is gone up to 9 million. But remember, you can't increase your asset unless you really sell the assets. Then only you incur the income. Now say everybody holding a vehicle, car. Look at the car market currently. Every car prices has gone up. The people who bought the car for 7-8 million now can sell it for 10 million or more than that. People who bought the car at the rate of 10 million can be sending it to 15 or 16. Some are going up to 19 million. So it is the real value. No, your purchase price is only 8 million. If you sell it to 19 and then recover, right, accounting is okay because you realize the money. Then you make a profit. But if the loss happen, you have to write off, because loss happen means it's a real situation. Something crashes your business, your real amount is what you can recover it currently. So your asset cannot carry a book value higher than the recoverable value. That is we call impairment, right? So impairment is very important in accounting because that gives a clear picture. Otherwise, the business will collapse. All the assets you increase the prices, the actual market prices drops. You have to adjust it immediately. If the prices go up, you should not adjust in accounting unless the amount is really recovered. So 5 million house went up to 8 million. You sell it and take 8 million into the cash, then you show the profit. If not, you can't show the profit. But on the other side, if the market crashes, you need to be aware of providing impairment. That is called impairment, right? Right. So in IFRS is International Financial Reporting Standards. So actually, we have International Accounting Standard (IAS). That is the everybody follows that International Accounting Standard. That got replaced in Sri Lanka from 1st of 2018. We have moved into IFRS Standard 9, right? So in Sri Lanka, every bank, every organization got into IFRS 9, the number categorization number 9 IFRS. 1st of January 2018, all the finance institutions got into IFRS, all including all the banks. What is this IFRS? It is the International Financial Reporting Standard. That means what happens is all this time, every region, every country, every organization have their own accounting standard. But what happened? These accounting standards, what we follow in Sri Lanka, maybe differs from India, maybe differs from Europe country. So they internationally, this accounting body wanted to maintain a set of rules so that everybody follow this regulation, so that accounting can be compared with the region to region within the industry. So you can do anything if you are following the same method of accounting. That is what IFRS. That means everybody doing accounting has to follow the set principles. You can't deviate. Previously, yeah, you have your own policies, you can deviate. But once you got into IFRS, everybody has to do the accounting style. Otherwise, auditors will not certify your account. Because remember, if you are a public quoted company, your account has to be IFRS compliant. It's a mandatory. Then what happens when you are giving it, when you carry out your business, end of the financial reporting period, you do your accounting and it's given to auditors. Auditors go through and they find a lot of irregularities. Why? You have not followed the IFRS standard. So you need to adjust that. Sometimes it's very difficult to adjust it. There are a lot of fundamental errors that have been made. So you need to, before you publish, before they certify your accounting, you have to rectify all the errors. Right? Then only they will certify the account. So international reporting standard, international financial reporting standard is a common language in all the financial institution or all the organization when they're reporting accounting, when they're preparing the accounting. All are same standard they follow. So it's IFRS provide worldwide, everybody's worldwide standard, they maintain the same standard. So you can say our bank, a bank can be compared with the bank in India, because India also having IFRS, we also having IFRS. So your organization can be compared with the neighboring country, or maybe the Asian region, everybody IFRS, you can compare your region. Globally, you can go and compete with others. But if your accounting standard, a standard loan within your country, that cannot be compared. That is the reason IFRS is recommended by international bodies, everybody, because it gives the transparency, accountability, efficiency. Because you can compare. Because what happens is when you are having IFRS standard, foreign investors, when they come and invest into Sri Lanka, they know all the organization in Sri Lanka doing account according to IFRS. So that he can make a decision making whether he want to invest in Sri Lankan bank or Sri Lankan company. He knows how to look at the profitability, how to look at the asset base, because everybody reporting the financial in a similar manner. If Sri Lanka doing accounting similar, different than the any other than the country from the investor where he is located, then he might find it difficulty to match his accounting, because he knows to certain standard is in his own country, which is IFRS compliant. But when you want to invest into a particular country, even that country is doing account according to IFRS, easy for him to compare. So there is a transparency, there is accountability. So that makes the life easier. That is the reason everybody follows. So this is the standard Sri Lanka follows, right? From effective from January 2018, all the banks are IFRS compliant. So here, what happened when this is the international standard, the bank's IFRS policies are very, very strict and stringent. Stringent means very strict policy. So according to IFRS, when a bank grant a loan, from the day you grant the loan, you have to do the provisions. So see how strict it is. You don't wait for 3 months the loan to go overdue. No, from the day one you grant the loan, you start providing provisions. So these rules are very strict rules. So when you follow IFRS rules, sometimes your bank's profitability initially it should have got affected. I think 2018, if you take the result of all the banks, 2018 result Probably it would have come in 2019. 2018, most of the banks reported their accounting in IFRS standard. Their profitability would have come down compared to the previous year, or maybe declined up to certain amount due to the heavy provisioning. Because from the day one you grant the loan, even if you are having a package for a customer, say you have particular limit for a particular customer. So this IFRS regulation direction says even the unutilized commitment of whatever the limit for the customer also need to be provided provision. So this is very strict regulation. So there are certain things which, as a developing country, we have a limited balance sheet. So when you do provisioning, undrawn, so you can see the number 4 point here, number 4. This means the bank will have to recognize provision from the day they extend any loan, including undrawn commitment. Undrawn means that the commitment has been not even utilized by the customer. So when you set a limit for a customer, the amount of the limit to be do the provision. So you can see why this is so stringent, because what happened, the IFRS and all these international standards are put to practice by international organization who's going through the difficulties of all the banks globally. Because they found certain bank has got into problem because of bad loans. So they want to rectify that, how to address that issue. From the day one you grant a loan, you start providing provision. Though initially going to affect your profitability, but once you started adopting this practice, you are geared. Any bad situation come, you don't collapse. You don't never collapse. You will be very strong to withstand any difficult situation. That is what IFRS 9s are so stringent. Once you now, I think all the banks are IFRS compliant in Sri Lanka. So I think it's now a matter of adopting these policies, right? So if you want, just say IFRS and say IFRS, International Financial Reporting Standard. You can say it is a set of. It is a set of. It is a set of. It is a set of accounting rules to be applied. It is a set of accounting rule to be applied by all institution, including banks, by all institution including bank, by all institution including banks, when preparing financial statement. When preparing financial statements. When preparing financial statements. I think IFRS are generally used by all the European countries, Asian, Australia, all these are using. But USA doesn't use IFRS. They have a separate. They have something called general accounting, generally accepted accounting practices. I think. So you can say IFRS are mostly used by European countries. IFRS are mostly used by European, Asian, Asian and Australian. European, Asian and Australian countries. Then you can say it benefits the economy. It benefits the economy. It benefits the economy. It benefits the economy by increasing the growth of by increasing the growth of its international businesses by increasing the growth of its international businesses. Further, it provides further it provides further it provides further it provides consistency further it provides consistency, transparent consistency, transparency or transparent, consistency, transparency, and 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 accounts are easily comparable with any organization in the world, with any organization in the region. You can say not the world, any organization in the region. Accounts to be easily comparable any organization in the region. Right. So that is about. Okay, now we are moving on to the statement. So you can say, you know this, right? There is something called, there are two statement banks preparing. Very important. One is, that is P&L. Now you don't call it as a P&L, you call it comprehensive income. So remember, income statements are prepared for a particular period. In accounting, you prepare income statement for a particular period. Generally for a financial calendar year. Right, in financial calendar year starts in Sri Lanka 1st of January of each year. It's end of 31st December of each year it ends, right? In some country, the calendar year starts as 1st April a particular year, and the next year 31st March it sees. So the calendar year, you can see 12 months is the calendar year. So financials are prepared for a 12 months period, especially comprehensive incomes are prepared for a 1 year. But remember, in Sri Lanka, according to IFRS, each quarter you have to produce the account. The comprehensive statement, though annually it's done, each quarter you have to prepare and publish to the, because all the public quoted companies are required by the law, they have to show their accounts to the shareholders. Because when you say public quoted company, how do the public quoted company collect their capital? By selling shares to the general public. That is what you call public quoted company. So the public quoted company collect their capital by issuing their shares to the shareholders, who are general public. You and me can be shareholders of any organization, right? You can buy any quoted company share. You can get into Colombo Stock Exchange and go whatever the shares you want to buy, you can acquire, you can buy the shares. Then you can have a dividend or whatever profit you can enjoy. And if you want, if you see the market is going up, you can sell it and get out of the market with a capital gain. So that is possible. But when you are acquiring a share, you are becoming shareholders of a company. Then what happens? The law says every shareholders of each investing company, the company has to show their results to the general public in all 3 languages. In newspaper, all 3 languages you have to show. And you have to send the financial reports to the shareholders. Sometimes if you are buying shares, you can get frequently. Every quarter, the accounting material will come to you. Or some banks are sending annually CDs. They stop sending CDs also. They say, log into our website, and all the accounts are uploaded in their website. So it's driven, technology driven. No point spending more money for the printing material. Now the accounts are, you can view the account if you really require, right? So therefore, the accounts are prepared in both income statement prepared for a particular calendar year, and then you can see the balance sheet. That is, you call balance sheet is called statement of financial position, which has 2 sides, asset side and you can see the liability side. right? This is how the financial. So little bit on financial. So if you really look at it, how the income of the bank is reported, you can see the income. The 59,500 is the total income. The breakdown of the 59,000 is two sources. It is one is interest income, other one is non-interest income. So the 59,500 total of interest income 51,868 plus non-interest income 7,632. So the bank's main source of income coming from interest income. So that is 51,000. So on the top, what is given is not the total income bank generated. It is just a figure is reported. Their total income added both main stream of income. That is one is interest income and non-interest income. Both together 59,500. Then actually when you realize the profitability, how do you work out? Then you have the interest income. Then you have to minus the interest expenses. Then you have a net interest income. With that, you add the non-interest income, then minus the entire operating cost. So how do you derive this profit before 12,000? How do you derive? So actually you can do this way. You can straight away take 59,500, which is the combination of 51 plus 7,000. So you can take 59,000 minus interest expenses 26,000 minus operating expenses 20,000. You get 12,000, right? So you have both way to do. So many ways to do. Take 59,500 minus interest expenses minus operating expenses, then you get 12,000. That is one way of doing it. Or else you don't take the top figure. It's just a stated amount. So if you really do the accounting, you know interest income minus interest expenses, net interest. So 51 minus the 26,000, minus it. Then you whatever amount you get it. With that, add the non-interest income. That is also other income. Then minus the operating expenses. Then again you get the 12,000, right? So the 12,000 can be derived either by taking the total income minus the expenses and the operating expenses and the interest expenses. You get 12,000. That is before you pay the taxes. You got to pay your taxes because the Inland Revenue has imposed certain taxes. So whatever income you generate, you have to pay taxes to the government. Every organization has to pay taxes to the government. Then you say income tax on profits. Whatever the profit you make, you need to pay income tax. Thereafter, you get after taxation profit. That is what you have two things. Profit before tax you call PBT. Write down the word. 12,063 is PBT. Profit before tax. Profit before tax is PBT. PAT, profit after tax. 9,500 after tax. That you call PAT. So sometime when you give the figure, they will ask, is it a PBT or PAT? Is it a profit before tax or profit after tax? So the profit after tax is the net amount. That is the gain. That is the current year net amount you earned out of your entire operation. That shows income statement. So comprehensive income statement, every public quoted company has to do the accounting comprehensive income statement. It is generally prepared for a calendar year, and it shows all their income minus the expenses, how they manage their assets, how efficiently they manage their assets and liability and earn so much of profit, right? That is comprehensive income statement. So if you want, just make a small note on that comprehensive income statement and say, income statements are prepared. Income statements are prepared for a particular financial year. For a particular financial year. In Sri Lanka, the financial year starts. In Sri Lanka, the financial year starts on the 1st of January. On the 1st of January of a particular year. 1st of January of a particular year, and it ends 31st of December of the particular year, and it ends 31st of December of a particular year. right? You can say, then next part you can say income statement shows the profitability of the bank. Income statement shows the profitability of the bank over a period of over a period of over a period of time over a period of time, that is 1 year, right? Then you can say it provides it provides very good insight. It provides very good insight it provides very good insight how well how well bank manage. It provides very good insight, how well bank manage their cost their cost their cost against the income against the income generated in the said period, against the income generated in the said period. So this is the comprehensive income statement gives you the picture. It's prepared for a particular calendar year. It gives the insight how well managed the particular bank is managing their income and how much expenses they incurred, what is the profit they made. So this is just a snapshot of a income statement. But in reality, you have breakdown of all income coming from which sources, interest income coming from where, what are the breakdown of operating expenses, all that is there in very in-depth detail. This is, I'm taking a snapshot of income statement for you to understand, so that you know how this 9,000 derived. The main source of the main ingredients of the income statement comprise of income derived from two main sources, that is non-interest income and interest income. The interest income is interest income minus interest expenses, if you are net interest income, plus your other income, then minus the entire administrating cost or operating expenses. Then you derive your profitability before paying taxes. Then you pay your taxes, then it come after paying taxes, your profitability. So that is how the income statement derived, right? Let us look at the statement of financial position. Remember, financial position could be taken at any given day. Income statement, you prepare it for a particular calendar year. But financial statement can be taken any given day. That is your financial position. Your assets and liability always equal. Your asset has to be equal to liability. So financial position can be taken at any given point of time. Sometimes when you see, when some companies, when they come to bank for borrowing, bank definitely asks, can we have your financial position asset? If you are coming for meeting tomorrow, can we have your financial statement asset last week? Can you bring your financial position, which is generic name is balance sheet. In accounting, conventional name for financial position is called balance sheet. Balance sheet has two sides. One side asset side, other one is liability side. Generally, if you take on your right hand side, you have the asset. On your left hand side, you have your liability. That is how the T form, traditional conventional balance sheet. But now it is reported in a statement form. It says statement of financial position. It's the same. Balance sheet and the position financial statement are the same. Only thing is, it's a matter of reporting. The way different methodology used to report the figures. That's all. The policy, concept, principle, everything remains same. So your asset always equal to liability. So you can see 576,000 your total asset comprised of breakdown of few assets. You can see the liability side, same figure will reflect. Yeah, 576,636. Your liabilities will reflect. Right. Then it becomes, you will think of, okay, what are the assets if you really look at the balance sheet of a bank? What are, you can see the biggest amount is asset is what? Loans and receivable. Yeah, loans and advances where you are supposed to receive from your lending. So that is your biggest asset. That's what I told. The biggest asset of the bank is loans. The biggest liability side, look at the liability, 409,377. That is in millions. You had put other 5 zeros. That is the deposits. So bigger amount in the liability side is the deposits. The bigger amount in the asset side is the loans. So that is what you study. The basic of banking is what you take the depositors' money. So when you take depositors' money, you need to repay. Therefore, deposit is liability. So what you do with this deposit? You lend. Then it become loans. The loan become assets. So same thing happen in normal business, in ordinary. Think of an ordinary person doing buying and retail business. He puts some money, right? Say 100,000 he puts. When he put 100,000, the 100,000 cash coming to the business. In accounting, remember, there are certain basic concepts, right? The accounting entries are always double entry. One side is debit, other side is credit. The fundamental of accounting is, remember, when you do accounting, always remember you do accounts for the organization, not for the owner of the business. The owner is treated as a third party. So that is the reason when an individual doing businesses, when one sole proprietor doing businesses, when the person doing accounting for that sole proprietorship, consider when accounting is done, consider the owner is a third party. That is why the whatever the amount put by owner as a capital to the businesses, the business need to repay to the owner. Therefore, when you're preparing accounts, remember, though the owner is the same person of the business, in accounting, the owner is treated as a third party. Therefore, whatever owner put into the business has to repay to the owner. That is the reason when one person put the capital reflect as a liability. Why? The business has to repay to the loan. But that liability definitely should have some assets. So if take example, somebody put 100,000 to start a business. If somebody asking you, write down the double entry, which there should be debit in one side, there should be credit in one side. Both has to equal. So in balance sheet, if you really look at it, he put 100,000 as a capital. So what happened in business? That 100,000 is created as an obligation. So you create a capital account and post the transaction in the credit side. At the same time, you create a cash because you put the 100,000 cash form. So you prepare a cash account and debit the cash amount as 100,000. So you can see your cash account as a debit of 100,000. Similarly, on your credit side of the capital account carrying 100,000. So in accounting, remember, each transaction has a debit and a credit. And the debit is equal to credit. That is the reason financial position shows all the asset sides are debit side. All the liability sides are credit side. So in T form, if you put it, on your left hand side, you get all your liabilities. On your right hand side, you get all your assets. In banking, if you put the banking balance sheet, it's quite different from other businesses. Because here the assets comes, the bigger figure comes as a loans and advance. In normally, when you take the balance sheet of a normal business, their bigger asset is their own building, fixed asset, their buildings. Land and building is the biggest amount of their balance sheet. They don't have any deposit because they can't collect any money from the general public. Therefore, you see the bigger difference between normal business balance sheet and the bank balance sheet. The bank balance sheet have two different things coming in. One is deposit, other one is loan. Rest of the things remain same like other businesses, but the concept of banking itself different from other businesses. That is the reason on the liability side you get a new item coming in. On the asset side you can get a new item. Liability side, you see loans and receivables. You never see any balance sheet of any other businesses, loan coming there, deposit coming there. But in banks, you get that, right? That is a different, right? Remember, in exam point of view, if you get a question, how the income statement or the balance sheet of a businesses differs from a bank balance sheet and a bank income statement, quite different. You do your businesses with your own capital. So if your asset side, you have only a fixed asset and current asset. On your liability side, you will have your own capital. And if your capital is not enough, you should have borrowed from a bank loan. That's all. Nothing else. So business is done out of your own money. But here in bank, business is done out of the depositor's money. That is the reason deposit is considered as a liability. But in businesses, capital is considered as a liability. But in bank also, remember, you don't do the entire business of the depositor's money. Yes, the shareholders of the bank also put the money. That is to cover the losses on. You can't do your business, day-to-day business with the capital because it's very expensive. Because the shareholders expecting more returns. So therefore, remember the fundamental difference between an ordinary bank, ordinary businesses and the bank quite different, right? That is the reason you can see the asset side as a different item comes as on the top with the higher figure, loans and advance. On the liability side, you can see the highest figure, customer deposit. You don't see these two items in any of the balance sheet of any other organization. Only banks you can see. But fixed asset, other asset, all that are there, shareholders, funds and all same. Any businesses, you have the capital. Yes. You have the reserve. That means you accumulated profit. You are earning profit. Everything is reflected here. Right? Okay. Now, go back here. Asset, right. Assets have now, if you go through the assets, what are the assets? Main assets, loans and receivable assets. You have a cash, you have a short-term funds, you have your funds are with central bank, statutory reserve requirement. All that's are your assets. You have a property, you do the bank also has a fixed asset. Banks also having their land and building and branches, all that comes as a property, plant, equipment. So there are taxes bank has to, there are some taxes bank has to pay. Maybe that taxes has to come back to the bank as asset. Those are deferred taxes. So you pay certain taxes that are on a long-term basis that will come back to you. That is what you put it as asset. And any other assets. You have a lot of other assets, right? So when you say a lot of other assets, you have a goodwill, your bank has a goodwill, that also asset. You have all your materials, all others considered not as a fixed asset, all as a current asset. So yeah, right? All your other assets. Bank might have, other than the equipment plant, bank might have their lobbies, there are chairs, there are fans, there are all heap of items are there. Your computers, your telephone, all that can be considered as a property and plant and equipment. Other than that, there are so many other assets banks possess, right? Their goodwill is one of the assets. There are other materials, other valuable materials they will have, right? All that is considered as other assets. So that is reflecting asset side. So you can just make a small note for your clarity purposes and say assets. You can say banks statement of financial position. Bank statement of financial position. Bank statement of financial position could be prepared, could be prepared, could be prepared, could be prepared, could be prepared on a particular day, could be prepared on a particular day, could be prepared on a particular day. However, it is generally done. However, it is generally done. However, it is generally done. However, it is generally done at the end of the financial year. At the end of the financial year. The balance sheet, the financial statement, you can say financial position, statement of financial position, or you can just say financial position. Financial position is also identified as financial position is also called as balance sheet. Financial position is also called as balance sheet. It's also called as balance sheet. Right? The balance sheet as both sides. The balance sheet has both sides. Balance sheet has both sides. One assets, you can say one assets, the other one assets, two liabilities. Right? Then you can continue to write and say it determines the risk and the return. It determines the risk and the return. It determines the risk and the returns. So what is the risk and return? So you can see the bank has made the risk and return means the bank take the risk, right? Bank, what is the risk they take? They take the depositors' money and lending it in the form of a loans. So where the loans are here, how the risks are distributed, what are the returns they got. So that is the net profit. So if you really look at the liability side, you can see, I think in this, I think they have missed out here. You can see, I think in this side, the earnings profit should be 9,005. Cut it off. I think they have, when they take this notes, they have not taken. 19,000 is not the earning profit. 9,005 only earning profit. So earning and profit, cut it off and write it against this 9,005. Earning and profit is 9,005, right? The 25,000 is reserves and the 19,000 retained earnings. So I think there is a mistake here, right? So what you could, equity capital 35,000 is correct. That is the owner's money. Reserves is 25,000. Then the 19,000 should be retained earnings. And the 9,500 is the profit, net profit. You can write and say net profit. So the reserves should be 25,000. The retained part of the retained earnings, the retained should come here with the earnings, and that is 19,000. Net profit is 9,005. So this is the 9,005. What we come across, what we declared here in income statement. This is the net profit. So every year, whatever net profit you make, that goes and added to the shareholders' funds. Because ultimately, this goes and added with the shareholders' fund. Here you can see 9,005 getting added. So every year, when this profit is added with the shareholders' fund, it is not going to the other liability side. It is going to the shareholders' fund. In really speaking, if you take the balance sheet consists of 3 items. Actually, balance sheet consists of 3 items. Can anybody tell me what are the 3 items? The entire balance sheet or the statement of financial position comprises of 3 items. What are the three items? Though the equation says asset equal to liabilities, but in real you can also call them as three items. What are those three items? Definitely asset is there, liability there. There is one more item, that is shareholders fund. So in other words, asset equal to liability plus equity or shareholders fund. So the liability side can be divided into two. Shareholders fund is separate, other liability separate. Both these items equal to asset. So you can write that and say in the balance sheet, you can say the balance sheet or the statement of financial position, the balance sheet or statement of financial position should comprise assets, liabilities, equity or equity, which is capital, equity, assets, liability, equity. Then you can say the assets equal to liabilities plus equity. Asset equal to liabilities plus equity. So the asset side is on the other side. Liability side, you can segregate liability and equity. Equity is the shareholders fund. So in remember, you do the business, you also put a certain amount of money, because that is the regulator says when you do the bank business, the shareholders has to put the money. But if you take this particular bank, the shareholders contribution is 35,000, right? That is initially they put the capital. Thereafter, every year they make some profit. That comes as a retained earnings, which is 19,000. And also they keep certain reserves for future expansion. That again from their reserves means you may revalue a asset, that also come as a reserve. Sometime what happened, this reserve would have been built up by when they acquire a land and building. Sometime what happened, the land and building carrying the old value. Say a particular Bank of Ceylon branch at a particular place, they have their own building. 25 years they keep the same value in their balance sheet. After 25,000, it has been refurbished, the building value is gone up really. So when the building value is market current value is gone up, say they bought it about 100 million, one of their bigger building, 100 million. They renovate everything, the current value is about 350 million. So the bank, no point of keeping 100 million now, the real value of the property is 300 million. But bank has added some value. So what the bank can do is over a period of time, it is not at all 100 million at all, because after 20 years, the building has been renovated, refurbished, and it is a total different value. So you have to get the valuation done, and you might revalue the building. At that time, whatever that comes belongs to the shareholders. That is called reserves. So you have certain reserves which coming from your capital gain, because when you invested something, you get some gain, right? By selling day-to-day date, you earn some profit. That is also accumulating. So you can just imagine how the bank's profitabilities are growing. You can see they put 35,000, right? Then they have reserves about 25,000. Then the current year earnings every year, not the current year, every time they retain earnings, that comes to 19,000. This particular current year, they made a profit of 9,005. So next year, when they prepare this 9,000, will go and add it with the 19,000. Their retained earnings will also go up, right? Therefore, these monies are there. This is the component central bank is looking at. Central bank keep on asking shareholders funds need to be improved, need to be grow. Why? When this is grow, any losses come, this money is sufficient to recover. So no, you take any risk, not a problem. Whenever your income statement carry a loss, say this particular profit after taxation, after taking all the provisions, you are ending up with loss. Say this particular year, lot of provision, bad debt, everything came. The bank incur a loss of, let's say, after everything, the bank incur a loss of 2,000, not a profit loss. Even this 2,000 can be borne by them. Why? You can see here, Yeah, they are 35, they are 25, they are 19. Only 2,000 this time minus coming here because loss. That 2,000 can be borne by their retained earnings. Simply they can borne by. That is the reason central bank tell them to increase your capital so that in any bad environment, if you are not making any profit, if this situation is a loss situation, still you can withstand. That is the reason, right? So you can say you start writing something for your references. Uh, how did I say start that? How did you start writing that? The balance sheet consists of three items: assets equal to liabilities and shareholders funds. So that is how you wrote, right? Then you can say, the balance sheet, the balance sheet, the balance sheet provide a snapshot. In other words, a brief look, a snapshot. Balance sheet provide a snapshot at a single point. Provide a snapshot at a single point. So now you are looking at this only this particular page. Very snapshot. You can take decision by looking at this figure, right? So it's a balance sheet provide a snapshot at a single point in time. The bank's assets and its liabilities and the shareholders contribution and the shareholders equity or shareholders contribution. You can say shareholders equity or shareholders contribution. Right. So you wrote some notes on your balance sheet. So the statement of financial position, traditional name is balance sheet. It comprises of two sides, asset side and liability side. In the statement financial position also, it has the reporting as asset separately, and the asset consists of loan receivable, the highest figure. They have other assets like cash, they are deposit with other institution, SRR, right? There are taxes and other assets, right? Then when you say other asset, if they have made some short investment in other places, everything comes as an asset, right? Any other investment comes as asset in the bank's asset side. If you look at the liability side, yes, liability side, the customer deposit. That means so much of money they are taken from the customers to acquire such assets. So right. So if you really want to see, for you to understand better, just put some figure here. You just put here 100. Put 100 here instead of 576. Just think of 100 here, right? 100. That is your asset total is 100 million or whatever. For you to simply understand, this 100 build up of these two. So here you put 80 and liability side put 80, shareholders funds 20, or maybe 90, 10 or whatever, or put 90 here, liability side 90 and shareholders fund 10, 90, 10 plus again 100. So your asset is 100, your total liability side also 100. The liability consists of the liability plus the equity, which is 10 and 90, again 100. So you can see your assets is 100 equal to liabilities 90 and the equity or the shareholders fund 10, again 100 to 100 balances. So in a snapshot, you can see this particular financial position shows the banks is so much of having deposit, 409,000 deposit. It's in millions, but for 409,000 they have deposit. They have borrowed from outside about 4,800. They have other liability. They should have borrowed from other organization 74,000. Then the shareholders contribution. Shareholders contributed 35. They have a reserve of the 25, retained earnings of 19,000 plus the current year profit. So much of contribute 576,000. This is the balance snapshot of a balance sheet, right? Then you know what is the balance sheet, what is it consist of, liability and assets, right? Now some basic accounting concept. If you go through this, is I have taken because of some of you maybe forgotten your O level if you have done your science stream in A level, right? If you are common stream, this is straightforward for you. Absolutely straightforward. Basic accounting, right? In financial accounting, assets are economic resources. Assets are economic because any assets has an economic value. When some assets is a value, that's become economic resources. Anything capable of being owned and controlled to be produced, value is considered as asset. Yeah. Anything to be owned and controlled and which has a value, then it become an asset. A liability is an obligation. So when you have an asset, the asset should have been acquired from past transaction. How did the past transaction is the obligation? That is, how did the bank acquire the asset? By taking the deposit. So the bank deposit comes as obligation, financial obligation, because they need to repay the depositors. But on the other side, the depositors' monies are used to acquire asset, which is loans and advance. So you can see the loans and advances considered as assets because that amount is due to the bank. On the other side, the liabilities are treated as a liability. The deposits are treated as a liability because the bank has to repay the depositors. There's a financial obligation. Bank has to repay the depositors. Therefore, depositors, whenever there is an obligation from the entity's perspective, per se, from the business's perspective, any obligation is considered as a liability. Towards the owners is equity. Towards the outsiders is a liability. So always remember, the liability, why do we divide the liability into liability and equity? Because the liability is totally outsiders. To the owners is shareholders fund. So the liability has two components because we are segregating external factors and internal factors. Internal is the shareholders people who put the money. Outsiders liabilities are external. That is liability. So that is how. Then you also are given debit and credit are used in double entry bookkeeping system as a method of recording financial transactions. Each entry into accounting system must have debit and a credit. Always involve at least two accounts involved, right? When you put a capital in a normal business, I said capital account is created, cash account is created. Every transaction has a two account, right? Two accounts are getting involved. In accounting, we often refer accounting equation assets equal to liability plus equity. That is what we have been talking about, right? Or asset equal to liability plus equity. Asset equal to liability plus equity. This implies that every asset that business owns is either financial right of the creditor, that is outside liability, or the owner. So the every asset of the business owned either by outsider or the businesses, own business. So when you say outsiders, it's creditors. That is what you call liability. If it is the owner, you call equity. So if your asset is 100, the 100 is owned by 90 outsiders, 10 owners. So your asset is 100, which is owned by creditors, outsiders, depositors, 90. And the owner shareholders, 10. So the asset 100 equal to 90 plus 10. That is what the equation says, right? An increase in an asset is a debit. An increase is a liability, of course, it's the other side, credit. We do this because two are opposite sides, so therefore debit and credit need to be equal. So when you add the debit side, when you add the credit side, both has to balance. That is what you call balance sheet. That is a double entry system, right? So to keep an equation to check, the opposite must be true. So suppose say, when
when you say asset is a debit side, if the asset need to be reduced, where do you park the figure? When a particular asset need to be reduced, you can't minus from the debit side. You can't minus. You put it to the opposite side. So when the asset need to be reduced, it will be having a credit entry. In the same way, the liability is always a credit side. If you want to reduce the liability, you put it to the debit side, opposite side. Huh? Whenever you want to contract, whenever you want to minus something, you always putting it to the other side of the account, T account, right? That is what for you to understand the last sentence I put it. To keep the equation check, the opposite must be true. The decrease in asset account is a credit because the asset is always a debit side. If you want to decrease, it has to be credit entry. And decrease in a liability is always a credit side. Decrease should be a debit, right? For you to understand better, right? Some important feature for you to understand: liabilities have credit balances, assets have debit balance. Now you know, right? Current liabilities are those which either become due, payment shall be fall due. So when you say current liability, this is for a normal business. We tend to use this word current liability. Current asset and current liabilities are generally comes for more appropriate for the normal businesses. For a bank also there are current assets, current liability, but more important to the normal business because they are working capitals. Because we should, as a bank, when you study balance sheet, remember we should study our own balance sheet. But also when we are granting loan to the businesses, we also should be mindful of the business's balance sheet. Therefore, you should know what is current asset of the business which you are going to grant a loan. You take the balance sheet of the businesses before you give a loan. As a banker, you should know the balance sheet of your own bank as well as the businesses. So when you look at the businesses, the business do their accounting in different perspective. They have their capital, they have their own funds, they borrow funds from the bank, and they do the business. Their asset will have a fixed asset or non-current asset and current asset. Their liability will have a liability, equity, outside liability, they will say short term and a long term. That's all. Theory remains same. In any balance sheet, liability assets are always equal. But for clarity purposes, you put the liability side into two: outside liability and the owner's liability. Owners you call shareholders fund, or equity you call it as a capital. Outside liability you call it as a liability. In businesses, outside liability also categorized into two: short term, long term. That's all the difference. Asset side you put current asset, non-current asset. Non-current is a fixed assets, and current asset is a running. So in businesses, what happened? The asset that could be changed within a year considered as a current asset. The liability which could be changed within a year called current liability. For example, in businesses, you have your stocks. When you sell credit, you have a debtors. You might have a bank balance. You have a cash balance. These all are current assets. On the current liability side, you will have your creditors. You got to repay the creditors. You have some accrued expenses. You have to repay your bill and all, utility bill, all that. If you take a bank overdraft, you have to repay the bank overdraft. If you are a normal business, those are current liability. So you have a current asset plus current liability. So that is how I have explained here for you to have some basic idea of accounting, so that when you do the ratio sum, we have some basic idea. Otherwise, it's no point taking you to straight away to ratio without knowing this basic fundamental. Now you have idea. Okay, in accounting, you prepare accounts for the businesses. In businesses, we treat owner as a third party. Therefore, whatever owners put into the business will treat as a liability. Therefore, it's considered as a capital. So the capital is a credit. Whatever the cash put by the owner to the business is considered as an asset. Asset as a debit side. So credit and debit are equal. So credit is on the opposite side, debit is the other side. So a balance sheet has both sides. So always asset equal to liability. That is the fundamental. But we liability, for clarity purposes, we divide to outside liability and the owner's contribution, right? Then current liabilities are those which are either become for payment shall be within 12 months. Current means current year, 12 months. Always remember current asset also 12 months working capital. So the difference between current asset and the current liabilities are the working capital of any business. So the working capital of the businesses is required for current asset and current liability. So generally, your business's current asset should be double the current liability. Say if a business has a current assets of 100, the best proportion should be current liability should be 50. Current asset should be 100. Generally 2 to 1. Current asset should be double the current liability. 2 to 1 is the best proportion. Anything less, they are short. Say you have 100 current asset, liability 70. That means you don't have much money to work around. Your working capital is confined because current year you are posting 100 asset, but in the same time you have an obligation to repay current liability, which is 70. So your 100 minus 70, you have excess of 30 only, which is you are running short of working capital. So always working capital should be, current asset should be double the current liability. Example, if you have a current asset 100, the liability should be 50, the best proportion. If your current assets are 150, 200 is very good. You can do more businesses. Your working capital is enough, right? So that is how the business. Net worth. What do you mean by net worth? Net worth and the long liabilities are also called long-term source of funds. That means in businesses, you take how do you run the businesses from the own money of the contribution by the owner. So the net worth and the long-term liabilities are also called long-term source of funds. So the businesses collect their funds from, whenever you do businesses, how the money coming to the businesses by way of capital, by way of borrowing. That is the source of funds. What is the utilization of funds? By acquiring assets, right? So you know source of funds, use of fund. There are two things you are learning. In balance sheet, remember source of fund. In banking, if you take what are the source of funds? Tell me what are the source of funds? The deposit is source of funds because that is comes as a liability. And the owner's contribution, equity, outside borrowing, all the source of funds. Now, tell me how these funds have been used. Source of funds, the funds are coming into the business. How this money have been used, you call it as use of funds. How do you use it? You are given the loans, you acquire assets, long-term assets, short-term assets, all that's are assets. So in balance sheet, you have source of funds. Other side, asset side is called use of fund. Liability side is called source of fund. So always remember the source of fund is called liability. Current liability are also known as short-term fund. Yeah, short-term. Other than the current liability, all the long-term, including capital, everything considered as a long-term source of fund. Short-term is current because it changes within 12 months. That is the reason we say current liability. Current means all other liability other than current is a long-term liability. But current is a current year within 12 months. Long-term liabilities and short-term liabilities are called outside liability. Yes, short-term and long-term other than the capital, all are considered as outside liability. Yes. Current assets are short-term use of funds. Yeah, use of funds. Remember, assets are use of funds. Assets other than the current assets are long-term use of funds. Yes, all your fixed assets are long-term use of funds. So now you know how the salient features of accounting for you to understand better, right? So with that, I think I have given enough notes to you. Shall we move on to the can you see the screen?
Yes, sir.
Right. Okay. Shall we move on to the commercial banking section 2, right? Now we are going to look at here ratio. We are going to look at the ratio analysis. So for you to have a ratio analysis, you should have some sort of accounting base. Okay. What is ratio analysis? The ratio analysis is from your P&L. You know now financial statement, right? You prepared your balance sheet, you prepare income statement. So there are so many figures appearing in there. You pick certain figures from balance sheet and the income statement and you compare. And that gives you the very, very good direction for you to understand where are we, how are we progressing compared to last 2 years. How are we progressing? So the ratio going to give a very good insight from the financial statement. You pick up certain and you compute, right, and you get certain figure, and that will give you the relationship between how much loan we have taken against our own funds. What is our profit for last 3 years? So you can calculate your profitability. How strong are we doing it? How much our NPA, how much our bad loans. So all that can be calculated under ratio analysis by taking certain figures reflecting in the income statement, comprehensive income statement, and the statement of financial position. We take certain figures, group of figures, and do the calculation. That provides summarized version of how this decision could be taken, right? That is what the ratio is very important in any field, right? The ratio analysis is very useful method to summarize certain figures and make comparison and see what is the growth. Where are we growing? Are we declining? So you can see when the financial positions are reported, when the banks financial report are putting in the newspaper, you can see our NPO grow, our NPO decline by 1%. All that is percentage they give. Our profit have been grow by 5%. You can see all that is ratios we are talking about. All the ratios. Our depositors grew by 5%. So they have grew by 5% compared to last year. Their deposit have been grew by 5%. Their loan portfolio increased by 10%. So all that is percentage. All that is you call ratio analysis. Right? That is how. So the ratio analysis important. It is a tool which enables the banker to lender to arrive the following factors. Yes, liquidity position. Yes, how much liquidity you are holding. Liquidity is the cash form or equivalent to the cash form. Financial stability, how the owner's funds, whether we have the capital, retained earnings, reserves, that is the solvency, the capital adequacy. Profitability, how well the bank is managing the assets and liability to make a profit. That is called profitability. So bank take depositors' money and lending. When they are lending, you have assets. How is the quality of asset? That is called asset quality. How well you manage your assets. NPA, you're talking about asset quality, all the loans, performing loan or non-performing loan. That is the asset quality. If you have a non-performing loan, your asset qualities are dropping, right? Safety and security, how financially you are sound. Whether you are safe, your capital is enough, you are maintaining a really required level of capital, and you well manage your NPA, then you are sound. You are a sound organization. Any investors would prefer to invest in your bank. Why? Your profit are growing, your stability is shown in the balance sheet. So this ratio going to give all this, enable you to give the outsider whether this particular bank, by looking at these position, whether this bank is the right place to invest. Generally, remember these ratios are generally attracting the foreign investors. Whenever they want to invest, they see what is the return on assets, what is the return on equity, how much when I put, how much return I'm getting it. Every shareholders is worried about their money. Whenever they invest, because when you are looking at investment, what do you think? Whether you have a money, whether can I put this money into the bank account, get a deposit of 3% and happy, or can I put this money into treasury bill and get a 4% and be happy, or can I put this money into share market and buy some share and get some money and happy, or can I start a new business with the other person? This is how the different people think. Different people think different investment opportunity. The person who willing to take more risk here definitely will earn more, but of course at a price. That is where you have to strike a balance. If you take a more risk, you will definitely earn more, but you are willing to prepare to take a risk. If you are a person, if you don't willing to take a risk, then of course you will only confine to the bank deposit. You have a limited income coming, that's all. But if a person who has the entrepreneur skill, business skill, decision making skill, never going to keep the money with the bank. He want to make it double, triple, right? So if you talk to business people, they know how they roll the money, how they keep the money rotated. Each and every transaction they use the money and make a profit. right? That is how the people do businesses, right? So you yourself, you can see how many online purchases you do for a certain item. These are business entrepreneurs. They make use of the opportunity. They are selling. They are very innovative. They are selling so much of electronic item which are manufactured here, like nice decorative item, furniture item, mobile device. All that's a very creative mind. But you tend to buy online. That is a good way of doing businesses currently. Because you don't physically, you don't go and things and check and buy, because you order online, because they have a good site to publish. Whenever you go through your mobile phone, you can see pop-up ads are coming. Those are attraction. That is how they do their businesses, right? Cautionary point before looking at the ratio. Yes, remember when you do comparison of ratios, there are certain things you have to be mindful. The date and the duration of the financial statement are compared should be the same time, same period. So now say, if you are comparing your organization with one of the Indian organization, there could be some issue. Why? We prepare financial statement calendar year January to December. But Indian calendar year from April particular year to March next year. Because that is how their standard is. But they are also IFRS compliant. Their reporting is their country regulation. Anyway, country regulation supersede to the international rules. These are not a law actually, these are recommendations. These are standard. So if you practice standard, your economy could be recognized internationally. That's all when you do these best practices. When you are, say, IFRS 9 compliant, when ADB want to give some loan to us, the first question they will ask, are you IFRS 9 compliant? We will say as a Sri Lanka, yeah, we are IFRS compliant. They know then there's all the accounting done as per the international standard. So they can easily work out, easily calculate all the figures, and they know whether this bank is sound. So when you do accounting, you have to remember, when you compare with one organization to other organization, both organizations do the accounting in the same period. If a HNB bank compare with commercial bank, both are doing same accounting period. Then only they can compare their result, right? It has to be same accounting period, right? And prepare same basis. Now with the IFRS, this won't arise. IFRS as a transparent method. So everybody who follows IFRS, the second point become irrelevant, because everybody use the standard international accepted format. If you are using different set of format, then you can't compare your accounting. That is how IFRS came. With the IFRS introduction, everybody doing an account in a similar manner. So you can compare those figures. Overall performance of the firm, group ratios. Yeah, so always remember the ratios. You can gauge how this particular organization has been performed. Generally, you need to have at least 3 years figure, 3-year ratios for you to identify where this particular organization is focusing, where they are growing towards. Are they growing? Are they showing growth? Are they traveling in the right path? That to get that indication, you need at least 3-year figure. So I think when you do ratios, sums and all, you can see we generally take 3-year figures and do the comparison, right? So that is some of the cautionary for you to when you do the ratios. The utility of ratios. So once you do the ratios, you can compare borrower entity and its competitor. Now see, you are the entity. Now Bank of Ceylon comparing their figures with People's Bank. Commercial prepare with HNB. Sampat prepare with NDB or Sela. So everybody preparing between borrower entity and best enterprise in the industry. Sometimes everybody IFRS, sometimes bank might say, okay, who is the best organization in Sri Lanka? There are John Keel's doing, Alice is doing well, and what is the other organization, other financial industry doing better? LOLC is doing better, right? So these organizations are doing better, right? So when you compare in the industry, who is the highest organization, and the bank is comparing with them, because everybody doing IFRS. So it's easy for you. So the ratio can be compared against the industry, against the same competitor. And you can, not only that, you can even industry-wise industry you can compare, and globally also you can go and compare, because if the IFRS is international standard. So you can see, you can compare yourself with the international standard. So the ratio analysis will help you to compare your figures, since most of the organizations are IFRS compliant. Yeah, ratio can be expressed in so many ways. Generally, percentage or proportion. So, say 25%, such as 25%, 50%. For example, if a net profit is 25,000 and the sale is 100,000, how do you propose the 25,000 of the profit against the sale? You say it can be 25% of the sale. So, out of 25% of the sale, 100,000 you sale, you make a profit of 25,000. In a percentage, you say 25,000 divided by 100,000. Your sale is 25%, right? So 25% of your 100,000 is 25,000. Or in proportion, if you say 1/4, 25,000 divided 100,000, your result is 1 by divided into 4. No 100. When it comes to proportion, you don't put 100. 100, when you put 100, is a percentage. Proportion, you don't put 100, you say 1:4. Now, current ratio, I was telling you, current asset, current liability, 2 into 1. A little while ago, I told you businesses are doing current asset and current liability. That is their working capital. So, always current asset to current liability, it has to be 2 to 1. That is proportionate. 2 into 1. That means current asset should be double the current liability. So, you say 2 into 1. 2 to 1 or 2 into 1. That is proportion. Sometimes you can say number of times. Sometimes you say the way such sales is 4 times of the net profit. 4 times of the net profit. Net profit is 25,000. If you say how much you say, you can say 4 times of my sales, 4 times of my profit is my sale. The sale is 100,000, profit is 25,000. 4 times of profit is 100,000. So you can say number of times also you can say. So the ratios are calculated in a different manner. Generally, percentage is more relevant to us. Sometimes a proportion also can come 1 or 2 ratios. Mostly on the right. So we are going to divide the ratios into 4 categories: liquidity, solvency, profitability, asset quality. What is liquidity? In bank, what is liquidity? The cash or the equivalent of cash. That is called liquidity. So why in bank, why central bank is more focusing on bank should have a liquidity? What is the reason? Why central bank regulator imposing the bank should hold more liquidity? What is the reason? What is the reason bank should hold more liquidity? Anybody can answer? What is the reason why bank should hold more liquidity? If the depositor come and he wants the money, can the bank say we don't have funds? Your funds have been given in the form of a loan. Better luck, come next time. Can you say that? Then the financial system stability gone. So you can't say. So that is what regulator says. You should hold enough liquidity to repay the depositors' money when they come and demand the money, or unforeseen withdrawal. There could be somebody come and withdraw, is pulling out all his money, unexpected withdrawal. So you need to prepare to have the liquidity, all liquidity-based asset, equivalent to liquidity like treasury bill, treasury bond. Why you are holding this liquid asset? Because in the event somebody comes, you want high liquidity going out of the bank, you might not have the liquidity. So you go to the other bank and borrow and pay that. So you should have a liquidity, right? What is solvency? Solvency is your strength, your financial position. That means your solvency means insolvent means you are financially bankrupt. Insolvency. Solvency, you are solid. That means that is your capital. Capital adequacy is the solvency. Your solvency. That means you can survive. Insolvency means you are bankrupt person. So solvency reflects the stability, financial stability. That is the capital, the bank's capital, right? Profitability. Yeah, profitability is very important. Otherwise, bank can't grow. The shareholders' expectation is to bank to make profit, right? And the asset quality, which is your performing loan. So the ratios are in exam point of view. These are the 4 ratios they frequently question you: liquidity, solvency, profitability, asset quality, right? So let us look at the liquidity. Yes, what is liquidity? You know what is liquidity, right? Liquidity is compared against the lifeblood. So lifeblood, without lifeblood, nobody can survive. So likewise, bank also, without liquidity, they can't survive. So the liquidity is compared to lifeblood of a human being. So it's so important to the bank in the financial system as a whole, because without the liquidity, bank can't survive. It's the ability to meet its obligation. So it's always ability to meet its obligation. Write the word. Its ability to meet its obligation is called liquidity. As they fall due, if the depositor wants the money, you should have a liquidity to repay. The liquidity of the commercial bank is the oil keep the bank moving. Yes. So I am comparing two things here. When it comes to capital, we compare the vehicle, but here the oil is compared against the liquidity. So in a vehicle, you require oil. A vehicle to move, you need the oil. So same thing in a bank to run, you need the cash for the bank to run. A vehicle to move on the road, it requires oil. Same thing, a bank to run, bank to do their day-to-day activity, they require liquidity. Otherwise, they can't run. People come and deposit money, people want to take the money, all that is liquidity, oil. So that oil keeps the vehicle moving. Same way the liquidity keeps the banks moving. Right. Bank require adequate liquidity relative to their commitment in order to maintain the confidence of their customer, particularly the depositors and their shareholders. Yes, the bank should have. Bank can't take all the money and lending and try to make more profit. No, they should keep certain liquid asset. So that you call I liquid asset, right? So generally, what are the I liquid assets? Tell me, at least give me 3 I liquid assets. Example, what is the most high liquid asset of the banks?
Cash in hand.
Cash, yes, cash. Then what? Is it only cash? Anything else? Yeah, you have your reserves. You have your gold. Yes, somebody try to answer. Yes. You have your gold deposit. You have your treasury bill. All that's equal. Those are high liquid assets. Okay, your cash, vault in cash in vault, your gold deposits, your investment in treasury bill, all are considered as high liquid assets, right? So banks require adequate liquidity, right? Okay. So bank business involve mobilization of funds. Yeah, you know the mobilization funds. We take the excess money from the depositors and lending it to the deficit unit in the form of a loan. That is the fundamental of banking. The first day we learned that, right? Always remember, banks mobilize the fund from the excess unit to the deficit units. What is the excess unit? The people who have the money, the depositors. They have excess money. So you take the money from them. What is the surplus? Surplus means short. What is the surplus unit or deficit unit? The people who want to do businesses. So you have excess, you have a deficit. There are 2 units in the economy. One unit has the excess money, they are the depositor. One unit has the deficit, they are short of money, but they want to do businesses. So the bank come as an intermediary, joining these 2 people together. So they take the money from the excess unit and giving it to the deficit units in the form of a loan. Take the money from the excess unit in the form of a deposit. So this is the fundamental, right? Take the money from the deposit from the excess unit and granting loan to the deficit unit, thereby making the economy to grow. Making the economy to grow. That is the intermediation. That is why we study fundamentally. Yeah? The performance of these functions, banks open them to several risks. Of course, yes, when bank take the public money as a form of a deposit and granting loan, banks are exposed to so many risks. Definitely so many risks. That's what we say NPA, everything is a risk, right? So the requirement of surplus unit means depositors are considered as a lenders and the deficit unit, borrowers. So the customers who deposit the money, we call them as a lender. We as a bank, we also lender, but we call them our depositors as a lender because they deposit the money with us. So they are lending money to us. So as a bank, we are giving it to the outsiders. So those people, we call them as a borrowers. So the requirement of the surplus unit, that is the lenders and the deficit borrowers, are diverse and conflicting. Yes, they are thinking and they are both of them needs are diverse and conflicting. But banks come as intermediary. Such conflict cause a great deal of problem. Hence, demand and supply of funds become unmatched. Yes, you know maturity mismatch. We studied maturity mismatch. I know. I think probably you are aware what is maturity mismatch. What is maturity transformation? Maturity transformation means you take the depositor's money and granting loans. So the maturity transformation means the short-term deposits are coming. You are converting into long-term. So you can see maturity
in transformation. That means short-term loans, short-term deposits are given in the form of a long-term loans. But bank knows, though they take the short-term deposit, not all the depositors are coming in taking the money. Therefore, bank knows, though it is a short term, that money, some of the monies are going to be there with the long term. That is what they give the loans. As I think initially we told, when person in the olden days, they have their gold, they go and deposit it in the store. The goalkeeper or the goldsmith, what he started doing it, he started lending all the golds. Then he realized people who come and deposit the gold never come to take their gold. Why? Because they don't want the loan. They want to keep for the safekeeping. So those golds are there. But when the goldsmith give a receipt, and the person who take the gold depositor take the receipt, and he go and exchange the receipt as a money. So the same thing, the same fundamental apply here. When the people are come and deposit money, they want this deposit to be there with them as extra. They don't want to come. So the bank knows most of the depositors will not come. Therefore, they are making use of the money and lending for a long term. But of course, there's a risk. When suddenly the depositor come and demand the money, bank should have a liquidity. Not only that, if they take the money and giving it to the wrong person in the form of loans, if the wrong person doesn't pay, there is a loss to the bank. And that is going to affect their capital, because ultimately they are going to take the loss from the shareholders' fund, the accumulated profit. That's going to impact the shareholders' fund, because shareholders want to grow their funds. They don't like these. Their hard earnings are taken off by these losses, right? Specific reason for bank to require liquidity. Why bank require liquidity? They need to be able to withdraw funds deposit, because when the depositors want some money, because the banks, this is the specific reason for bank to require liquidity. Why bank require liquidity? In the event if you get a question, you must remember, right? Why bank require liquidity? Withdrawal of the depositors. If the depositor wants a fund, you have to have a liquidity to repay the depositors. Yes, to meet the interbank. So sometimes you are short, you go and borrow from another bank, interbank. Say, I told you every bank will have their financial position a particular day begin with surplus, or they will have a surplus or deficit. So if they have a deficit, if they want fund, they go to the interbank call money market and borrow from the other banks. And that indebtedness, when they are borrowing from, next day they have to repay. That is called, to meet the interbank indebtedness. Indebtedness means you borrow from somebody, you need to pay in the interbank. So indebtedness means you need to repay the bank who lend you at a short term. So there could be situation. Today you have excess liquidity. Say Sampath has excess liquidity 100 million. Ceylon coming and borrowing from Sampath 100 million. But tomorrow Ceylon has to repay to the Sampath. So therefore they need the liquidity to repay to the Sampath as they borrow. So that is called indebtedness. Indebtedness you have to repay. To be able to meet unforeseen borrowing request. Yeah, sometimes there could be borrowing. You are going to grant a bigger loan. So you require funds to dispose. So what happens? Generally, banks credit the account. They don't give it. Banks, remember, when the banks are giving loans, don't think the banks giving in the form of a cash. No, banks credit the loan account. That is what credit creation coming in, right? So you remember that, right? Credit creation means sometimes banks are creating credit. Mean, what do you mean by creating credit? Say a person comes deposit 100 rupees. Now you're going to grant 3 loans out of the 100 rupees. 30, 20, 30. Balance you are keeping as a reserve, liquidity. So when you are giving 30, you don't give the money. You go account, customer's account, you credit his account. That 30. That 30, when you credit, that is also deposit. That money is with you. You are credit. You are giving other loan. You are credit other 30. So that 30 can be taken 10, other 20 can be deposit. So you can see out of this 100 deposit, you are creating multiple credits, because that money also can be granted as a credit. That is what the creation of credit comes. With the 100 rupee deposit, you are creating more credits. That is what creation of credit. So banks are generally creating credits with the one deposit. So same theory apply the goldsmith. He has a gold. He started lending the receipts as a loan. One fine day, he saw the receipts are more than the gold. Same theory apply, same fundamental apply. That is a creation of loan, here creation of money.
right? Creation of credit. Credit means loans. To meet able unforeseen borrowing, then to be able to cope with the interruption of the normal cash flow. Yeah, in the event you have a short of interruption or whatever, you should have a liquidity. Otherwise, you will have a problem. So banks, every banks keep the enough liquidity in their vault, right? So they must ensure that each and every time when they keep cash in the wall, they have to ensure the insurance also taken. Remember, you can't keep cash in the wall. Something happen, some theft or fire or whatever happens, there should be insured. So you need to be aware all the banks are insured against their deposit in the liquidity. Whatever the deposit they have in the form of a cash are insured. You have to take a fire policy. Okay, if the building can get caught to fire, flood can happen or tsunami can happen, whatever natural disaster, those funds need to be insured, right? Liquidity risk. What is the liquidity risk? The risk of loss of bank resulting from its inability to meet the need of cash from inadequate liquidity level, which must be covered by the funds obtained from excessive cost. What is the liquidity risk? Say somebody keep a deposit 1 million, he want to come and ask the 1 million deposit. Say your bank do not have. So you are going to borrow from a interbank call money market and lending. So when you are borrowing, you have an excess cost. You are borrowing and paying. Instead of if you keep your liquid asset at a desired level, you need not to go and borrow. So the liquidity risk is when you are short of liquidity. Remember, you need to borrow to pay the obligation. You can't tell the depositor when he come and demand the money, you have to immediately pay. All of a sudden, you realize he comes and demands the money, but when you go to check the vault, you don't have enough funds in the vault. So what you do, you go to the interbank call money market and borrow, and then you immediately repay the deposit. That is costing you excess cost, because whenever you borrow, there is a cost to the lender, because he has sacrificed and he has given that money to you. So what is the illiquid asset? Yeah, I give an example. Illiquid asset: cash involved, cash reserve, gold deposit, and security which could be easily converted into cash form, which is treasury bill. Yes, these are illiquid assets. Remember, in exam, if you ask what is the illiquid asset, cash involved, cash reserves, gold deposit, and securities which easily converted into cash. That is, treasury bills are considered as a illiquid assets, right? So cash involved, gold, these are illiquid assets. Okay. So what is liquidity management? So there is a liquidity management is an ongoing process. So you know there is I don't know whether you would have heard this committee. Yes, ALCO. I don't know how many of you heard this committee. What is ALCO stand for? Assets and Liability Committee. You can see assets, liability. What is assets? Loans. What is liability? Deposit. So Assets and Liability Committee, ALCO, is a committee I give power. This is CEO and the dealer, and if the bank has a different designation, sometimes you will call as a DGM, some bank call it as a general manager. At a top position, head of treasury, and the CEO and the COO, these top people get together, and they generally once a month they should have ALCO meeting where they decide. I told you this is the committee decide the liquidity of the bank. So they know, okay, are we short? Are we excess? If you are short, what are we supposed to do? If you are excess, what are we supposed to do? That is the reason sometimes you would have seen in a short term, you all of a sudden get a paper advertisement or whatever media, there is an advertisement. One bank comes and say they are offering a fixed deposit 50 basis point more than any of the other competitors. What is the reason? Can anybody tell me? If a bank A comes to the market in Sri Lanka and everybody giving 12 months FD for 4%, one bank come and offer 4.5, 50 basis point more. Any particular reason? Because the ALCO decided they are short, they are reserved, their liquidity is a short level because they are a lot of commitment going to come. So they offer a 3 months or 6 months deposit. They want to increase their liquidity level. That is the reason they come and offer. Because what happens when you offer 50 basis point more than the other competitors, everybody try to pull out their money and putting it to A bank. So A increase. Sometimes you can see that deposit is open for a particular period on. Within 3 months, they achieve the required target. Then the product is over. Thereafter, they will offer the normal 4%. So that is the reason you can see some bank comes to the short tenor to the market and come and offer 50 basis point more. Why? In order to grab more deposit for a shorter period, because they were short of deficit of liquidity. In order to get that liquidity gap, they come to the market. Sometimes you can see on the other side, vice versa. That is, they have excess liquidity. What is the product they come to the market? They have excess liquidity. Can anybody? When they have excess liquidity, what is the product they can come to the market? Will they come and ask for a? Will they come with their enough liquidity? Will they come and again offer more 50 basis point more for the deposit, or what is the appropriate product they come to the market with? Can anybody? What is the product?
Loans.
Loans, yes. Credit card, some bank might come and say we are offering credit card. Compared to other banks, we offer credit card. Why? Because they have excess liquidity. They can grant loan. Sometimes they might design a new product and say we are granting loan for teachers, business entrepreneurs. Why they come? Because they have excess liquidity. They want to utilize it. Because excess liquidity, when you have, if you put it into treasury bill, treasury bond, you have a limited return. Your yield are return limited, only 4%. But when you go and design a loan product, you can charge for 7-8%, double the deposit rate. That is what they're targeting for a loan product. So you remember, the ALCO committee decide whether excess liquidity, short liquidity, accordingly they navigate the maturity and bring the appropriate product. So this is the committee. Always remember, the liquidity managed is by the asset and liability committee, ALCO. ALCO is the managing the liquidity of any bank. So the treasury department, or you will have a treasury, I think every bank will have a treasury department, are the important department managing the bank's cash, right? So I think I have taken 5 minutes extra. So we will start working next class, all the ratios, be with the calculator. So your normal simple calculator or with your mobile phone, we can start working. So we will have some, I have given some example also, you can try. It is very, very straightforward. You can get the figure, but you need to write examiner. How the trend comparison, which bank is doing better. That is what you calculate the ratio easily. But therein after you need to explain to the examiner is something that you need to develop. So we will do some example. Then I will make sure that you will have the writing ability. What should be very brief, but to be precise to the point, right? So we'll meet you in the next class then. Okay.